All right, guys, I'm so excited today here with us. Okay, we have this special, very special guest. Okay, this is CEO, Top Wealth Strategist, future on Fox Business every week. And man, we're so honored to have you today, the Hustling Podcast. Thank you so much, brother. Rob, welcome.
Yeah, thanks for having me, man. I see you blowing up out there, Jamar, with this hustling podcast, and my boy Albert was on there, first guest. I don't know why I wasn't first guest, man, but I'm not gonna complain. Sometimes it's better to be a fast follower than a leader. So congratulations on your success too, brother.
Thank you, brother. Just Albert was a good mentor, first mentor of mine, and I was like, man, it just makes sense to have the the first one to be like that first mentor that kind of like it was like a turning point, in my life. So I was like, let's do Albert first one, then we go from there.
Yeah,
Brother.
that respect, man. I know, I've been listening to some of your stuff. I know you talk a lot about the key to your success being loyalty and having that circle of influence and those tight relationships. So the fact that you went back to Albert for that, yeah, much love on that. That's the way you do it, man. The people that help you, you make sure that you help them out also.
100%, brother. 100%. Hey, so first than anything, I know that you're like on Fox every week, talking about stocks, finances, that with the exotic cars over in California. But for those who don't know you, who is Rob Luna?
Yeah, Rob Luna, brother. Yeah, I think a lot of people see me today. They see all the degrees I have. They see me out here in Los Angeles. I've been on television, CNBC, Fox, Bloomberg for about the last 8 or 9 years now. And they see kind of that success, but they don't know I grew up, pretty poor in a really bad neighborhood of Los Angeles. My mother was, fighting drug addiction a lot part of her life, split up family, grew up, extremely poor, on welfare, food stamps, the first in my family to go to college, the first in my family to buy a home. So, what you see today is not necessarily where I came from. That's kind of one of the balances though I always have with my daughter, because my daughter obviously is going to have a much different path that I have. But it's still, when I look back at some of that adversity, those challenges that I had in my life, those are really what made me, who I am today. So I don't complain about any of that stuff. I'm grateful for having those experiences. Thank God he's kind of watched out for me, all along the way and put me in a position today where hard work, dedication, and some of those lessons I learned all along the way, fortunately has led to some success in my life.
Right. Wow, that's an amazing story, man. And I'm like the second question I want to ask you is like, how do you build your wealth to the point where you're at today?
Yeah, so a few things. I started investing in a very early age. Like I said, I actually bought my first home in college at 19 years of age. I did my undergrad at Arizona State, so I left California. I wouldn't have been able to afford anything in California, so I bought my first house out in Arizona at age 18 or 19. So that was one way to not pay rent and start building some equity in that mortgage, which we then flipped to second, third, fourth, and fifth homes. I started buying some stocks in my early 20s. Amazon was one of those stocks that I bought late 90s, which turned out to be a really good investment. But I'll tell you, Jamar, the number one investment that I made, where I still hold a large part of my wealth today, is in my own business. I started my wealth management firm. I left a big firm that I worked for at age 26. So I started this about 17 years ago, built it up to we're managing hundreds of millions of dollars for private clients. And just this year, I wound up taking some money off the table. I sold 70% of that business to a publicly traded company. So took a little money off the table, but still owning 30% is a large part of my net worth. So I'm a big believer in entrepreneurism. I'm a big believer in investing in other people's businesses, investing in your own business. And for me, there's no better investment out there than in your own business.
Man, I love that. I love that. So you kept 30%, you sold 70%.
Yeah.
That's amazing. Hey, I'm very curious because like I got into real estate because like I remember when I was a kid, I used to go to my uncle's house. He had like a mansion right in front of the beach, And by the swimming pool, you could see the beach, and he will always like smoking cigarettes. And I knew he was a multimillionaire, so I was always like listening to him, and he always was talking about like real estate, and he owns a bunch of apartments. So that's why I got into real estate, right? Because like from being a kid, I kind of saw the relationship between owning real estate and being a multimillionaire. But I'm curious, what about you? Like I could see that you're very passionate about stocks.
Yeah, yeah.
I've been looking at a lot of videos of you but what got you into stocks? Like why stocks? Why you're so passionate about it?
Yeah, well, I think it's a couple things. Number one, it's what you know, right? So I think you have to invest where you have some type of a competitive advantage and things that you know. And so, I definitely didn't grow up with any millionaire uncles. I didn't see money that was made in real estate. So quite honestly, a couple things. Number one, I fell into the stock market. I was a freshman in college, wrestling, and I needed a job. And, I heard that they were hiring for stockbroker trainees. I was like, well, okay, I could do that. Went into the market when I was 19 as an intern. So that's just kind of what I learned very early on. And so by putting some money into some really good companies, Google, Amazon, those types of companies years ago, I saw my wealth grow exponentially through that. So that's kind of what I grew up. All my education has been in that. So I'm very comfortable with the stock market. Real estate is, a great investment also. I would say though, businesses have the ability to grow much faster than real estate. They could expand into new markets, the way, and I worked, in this business for about 20 years. So outside of being an entrepreneur myself, managing my own wealth, I've been fortunate enough to work with several other entrepreneurs. I work primarily in my wealth management firm with professional athletes. So that's one segment who gets a lot of money at one time, and they've got to be able to invest that for the rest of their life, but also entrepreneurs, which is very similar because a lot of entrepreneurs, I had a client that we helped to get to a $170 million valuation exit about a year and a half ago. Wow. A year before he did that though, essentially, he maybe had $100,000, $50,000. All his money was tied up in his business. So again, it goes back to investing in businesses, whether they're private businesses, whether they're publicly traded companies. Those are things that just tend to grow faster than anything else. Real estate, I do own real estate, but I look at that as more a store of wealth. I look at that as more cash flow that you create, but it's very hard to get rich in just real estate because you need that initial investment. A lot of people make their money elsewhere and then get it into real estate to be able to expedite that growth, to be able to expand on that wealth through real estate.
Right. 100%. Hey man, this question is gonna be tricky, but I know a lot of people like they want to hear what you have to say on this.
Yeah.
So on your expertise, right?
Yeah.
On your opinion, what will happen to the real estate market? What will happen to the stock market if Trump wins or if Biden wins?
Yeah, so it's a great question. That's $1 million question, right? So I think a few things, one thing I've been talking about a lot on television in the last few weeks is that the stock market, first of all, is forward looking. So they're trying to price in what they believe is going to happen well before it actually happens. And at the time that it happens, usually that's all been priced in, either the downside or upside. So let's first talk about the presidency. So, Trump or Biden, right now, the polls are showing that Biden's going to win. Doesn't necessarily mean he's going to. It's also showing that Clinton was going to win prior to Trump winning 4 years ago. But if you don't think that the market is anticipating that Biden wins, like you're mistaken because, the odds are he will win. So the market's already started to price that in a little bit. And so if that happens, I don't see the stock market doing much. Obviously, you can get a 5 to 10% sell-off. That happens. A 10% sell-off in the market happens on average every 12 months. So just because you see the market pull back, that's just normal volatility. Remember, Jamar, stocks are liquid. Real estate, you can't just hit a button and sell it all and liquidate it in 24 hours. Stocks, you can. It's because of that liquidity that you have a lot more volatility in the stock market. The thing I'm more concerned about, what we're looking at for our clients, is really what happens between the House and Senate. Now, if you have the Democrats take over both the House and the Senate, and you have the presidency run by a Democrat being Biden in this case, then it's tough because there's no checks and balances. And so when you look at things like regulation, you look at things like taxes, those are usually not favorable to people with wealth. They're usually not favorable to business owners. So I think looking at that, and there's some key states like Iowa, Texas, Arizona that you want to keep an eye on there. If you get a red sweep, that's probably the bigger issue. And I think the stock market would not deal with that nearly as well. Real estate, let's remember, real estate's based off really two things long run. Number one, it's abilities people to be employed and be able to pay a mortgage, obviously. Number two, it's largely impacted by interest rates. So let's talk about interest rates because I think that's the easier one. Well, the Federal Reserve is the one who sets short-term interest rates, which dictate everything else. The Federal Reserve has already come out and said publicly that they don't plan to raise interest rates until 2023. They've never telegraphed that far ahead in advance before. So in terms of interest rates, that's on your side as a real estate investor. In terms of jobs, that's going to remain to be seen. Now, taxes are more than likely going to go up under Biden. They were 35% prior to Trump, went down to 21. They won't go back to 35, but probably 28 on corporations. That could slow things down. The big question is what offsets that? Do you see things like infrastructure spending that creates some new jobs out of the Democrats that maybe can offset that? The other big thing is, especially in high income income tax states like New York, California, there's something called the SALT limit, so state and local tax deduction. And so what happened is with Trump, it used to be whatever. If you paid $100,000 in state taxes, you could write that off. If you got $200,000 in property taxes, you can write that off. Now there's a $10,000 cap. And so that actually made it less beneficial to buy real estate, especially in states like California, because if you make $175,000 as a couple in California, which is unfortunately barely getting by, that limits your further deduction. So any property taxes that you're paying are now non-deductible. So there's some talks about that actually rolling back if Biden comes in, and that actually could be favorable, contrary to popular belief, for real estate. So something like something you want to listen to, what happens with that SALT cap? Does that go away? And if interest rates stay low, that creates a pretty good environment for real estate. Last thing I'll add is everything that we're doing in terms of printing money, sending checks out to people, all these different things, long-term economically is very inflationary. You'll start to see inflation become an issue. And how do you counter inflation? A great hedge long-term for inflation has been real estate, because real estate holds its value. So quite honestly, I think in some areas you might see a little bit of some frothiness in real estate, but the underpinnings of the market really are relatively healthy. I said last thing, but the other thing I'll say, there's still a very large supply-demand imbalance. So there's a lot more people wanting to buy homes than there are homes for sale. So really, at least for the next 12 months, which is almost like a decade now when you try to predict out that far, it looks pretty good in my view.
Well, okay, man, that's a great information. I know a lot of people be looking forward to hear this. Yeah. So, hey, by the way, you know how that fighting style called jiu-jitsu, right?
Yeah.
Like they use the momentum of the other person. So check this out. Yeah. I saw you doing an interview to I believe it was Josh Altman.
Yeah.
So I saw a question that you did, so that I'm gonna use it now to you, because I thought it was a great question. So, so what's the biggest thing that keeps you up at night to you, Rob Luna?
Yeah, I remember that question. I think, I think the biggest thing that keeps me up at night is just some unknown event, right? It's just like the things that I know I'm okay with, right? The things that I can prepare for, I'm okay with. But waking up in the morning and hearing, like this year, COVID, for example, that wasn't on my radar. I didn't plan for that. Those are the things that are the toughest, right? Those are those, you heard the term black swan, these events that are very, very difficult to prepare for. I think that's what keeps me up at night from a business standpoint. Other than that, being a father, you always worry about your kids' health and those types of things. So I think things like that. But from a business perspective, it's always the blind spots, right? Being in finance, I do a lot of modeling. And so many people get stuck on their model. And one thing I always tell my young analysts here at our firm is, we're going to create a model, but the most important thing to realize is as soon as we create it, that model is already broken. There's blind spots, there's things that are wrong with it. And as long as you're aware of that, you're okay. And so again, that's what I'm worried about is what haven't I accounted for? What could happen? Those are the things that, you really need to set up a culture. You really need to condition yourself more than ever to be able to pivot, because what you're planning for tomorrow could change like we saw this year on a dime. And unless you have a framework in which to adapt your business to be able to succeed, you're not going to. And we saw some companies flourish this year and are doing better than ever. And we saw a lot of companies go out of business. And I think that's just the way it's going to be going forward.
Right, right. And actually, this was part of that question, but I kind of like split them.
Yeah.
Also, what's the biggest risk that you see on the markets right now?
Yeah, the biggest risk by far for anything is interest rates, right? Because interest rates control everything. So when it comes to, buying a home, obviously you've got 3-4% mortgages. Well, if that goes to 7, that's going to be an issue. Whenever you make any investment decision, it's always based off of a 10-year bond. So the 10-year bond is at 0.75%. Why that's, I've talked about this a lot lately, but why that's important today is, as an investor, you always have to see, okay, if I invest for 10 years with the government in a government bond, there's no risk. What are they going to pay me? Today, it's 0.75%. So it's not a lot. So you have to take on risk today. When I got started in the market right before 2000, that same government bond paid 7%. So look, first, and that's why the stock market crashed in 2000, because everyone could get risk-free 7%. Why take on any risk? And so that's happened though artificially. The Federal Reserve, again, they control monetary policy. They've kept rates low in order to create demand in the market for real estate, for businesses, for investments. But if something happens where they cannot constrain that and they cannot control that, something like China selling our bonds or some other force that allows rates to skyrocket, inflation could be one of those things, and interest rates tick up, you will see real estate crash. You will see the stock market crash. So if you're going to keep an eye on one thing, keep an eye on that 10-year bond.
10-year bond. Yeah. That's great information. Hey, I'm curious, right? Like somebody like you, that you're like tied into the markets on a daily basis, and like, what's your daily routine look like? Like, do you like do some research early in the morning, look online, like I don't know, early news or like what? How does your daily rituals look like?
Yeah, great question. So, I mean, I live and breathe the market, right? So I'm extremely passionate about it. So if I wasn't working doing it, I'd be doing it for myself anyways. So I think, before I go to bed at night, I'm always looking at the Asian markets. What's Japan doing? What's China doing? Because now, especially with the globalization of our economy, all our markets are tied together. So if you see Japan and China overnight having some issues, I'm pretty much conditioned to know that we're going to have some problems going into the morning as well. And then when I wake up, obviously I'm looking at futures. So you can go on to something like CNBC.com and you'll actually see kind of an early indication of what they think the market is going to do. But I'll tell you, in terms of the actions that I take in the market, the planning that I take at our firm, we have an investment committee. There's myself and 3 other chartered financial analysts. So smart people that are, we sit around the table, we have our portfolio, and we're making investment decisions absent of news, because it's just like at war, right? You don't start having shots fired at you and say, hey guys, we better formulate a plan really quick. You need to have that plan in place. And then when you see markets sell off, that we actually use as an opportunity. So we're not saying, oh, let's go ahead and sell now. We're saying, okay, let's have our shopping list of the companies we like. So your Amazon's companies, like I mentioned, when they sell off, we want to go in and buy. So Warren Buffett said, be greedy when others are fearful and fearful when others are greedy. That's what we try to live. And so on the opposite is, we had stocks that we've had big profit in. We're waiting for everyone to get really excited. And on a day like that, we might come in and execute. But the time to create your plan, the time to determine how much risk you want to have, how much risk you want to have in the market is not at a point of time and fear. Because I can tell you, doing this for 20 years, investors are always going to say, yeah, I want a lot of risk when things are doing good. And then when things are crashing, they say, I don't want to take any risk. So they want the 20% return, but we're taking out any risk. And as we know, you get paid to take risk. You don't get paid for safety. So the best opportunity to invest are during those scary times, but that's the hardest thing for the average person to do, whether it's real estate or stocks.
Right, right, right. It's like you said, buy on the rumor. Is that right? Buy on the
Yeah.
rumor.
Yeah, it's
S-
buy on the
s-
rumor, sell on the news,
Yeah,
right?
yeah, yeah.
Yeah, you got it. When you're thinking about it, you got to buy it. So everyone's, waiting for the stimulus plan to come out. And so look, the stock market's done good over the last month and a half. Then they're going to announce it in a week or 2 weeks, and the market's going to sell off. And they're going to say, well, we got what we wanted. Yeah, but the market went up 12, 13% ahead of that. So again, market's forward looking. It's going to anticipate what's going to happen a month, 2, 3 months from now, well in advance. Like the October 2007 S&P marked its high. You didn't see real estate really start to crash till about 6 to 7 months later. That really comes down to liquidity, right? Because if you are scared and if you see crap going really wrong, you can log into your Schwab account, your Robinhood account, whatever it is. You can just hit sell, turn it to cash in seconds. So that happens right away. So when you're looking at the stock market, when people are nervous, people want to make changes, you'll see it there first. But if I own 30 properties and I want to get out, I got to start listing them. And that takes time. And so before that hits the market, you've already seen the stock market move in advance. This is the corollary also. In October of 2009, the stock market started skyrocketing. You didn't really see that hit the real economy until about 6 to 7 months later. So whether or not you're in the stock market is extremely important. You need to understand it as any type of investor because that's going to be your real-time pulse of what's going on with the real economy.
Right, right. So basically, if the stock market crashed this year, and we could see, like, as a real estate investor, that probably by next year will be a lot of opportunities because, like you said, the stock market is the pulse,
Right.
and real estate market is a slower market. But you always, if you pay attention to the stock market, you could kind of predict what the real estate market will do,
That's it. That's it.
right?
Yeah. Yeah. And in the bond market also. And that's why I say keep an eye on that 10-year because if you see bond and the bonds, they said sometimes is a little bit smarter than the stock market. So sometimes you'll see the bond market lead. So we watch both. And so if the bonds start to take off, that's probably, like I said, one of the greatest risks for every asset class right now that if you see that 10-year go above 1.5%, it could get ugly.
Hmm. Right. Okay. Great, great information, by the way, man. And let me ask you something because I know like one of the main reasons of the interview is like to bring value. Also,
Yep.
like let's say somebody who's looking up to you, like what advice would you give to someone who want to be a private wealth manager like you, but doesn't know where to start? What advice would you give to that person?
Yeah, I'll tell you, Jamari, it's a lot harder today doing this when it was when I got into the market. There was a lot available. Like now, the tough thing is, to hire, to get a job, they already want you to have 40 or 50 million dollars that you're managing. It's really pretty difficult today. Also, when you think about it, when I got into the market in the late 90s, 98, 99, as a kid, essentially, the internet was like, that was AOL, right? So like the speed of it, like just to get some information, it was very difficult. Like I was in high school, I was going to the library pulling reference books, right? Well, today that information is right on your fingertips. And so when I got into the market, people were starved for information. Access to information was very limited. You couldn't get stock quotes. People had to call their broker to get stock quotes. So that information is readily available today. So you're seeing a lot more people do it yourself, which means if you want to be an advisor today, you need to offer something compelling. You need to have a competitive advantage to be able to do that, or else people aren't going to, like, why are people going to pay you to buy an S&P fund? They can go and do that themselves. It's not difficult. And so that's why really what I did is I focused very early on is what is my niche going to be? And my niche wound up being two things: entrepreneurs and athletes. And so when an athlete comes to me in the NFL, look, I understand the contracts. I understand what they're going to go through. I understand the politics. I understand what sports is like after that. Entrepreneurism is so important because about 80% of athletes, after they retire, they don't want to just go work a 9 to 5. So they want to start
Right.
their own business. So I'm conditioning them early on to start their own business as well. And then entrepreneurs, I feel like that's an area that I could add value in helping them with their balance sheets, getting ready for exit. So besides just telling them what stocks or bonds to pick, you got to figure out another way to be able to bring value and add value. Otherwise, you're competing guys like me with MBAs, 20 years experience, hundreds of millions of dollars under management. So if you're getting into it today, you've got to invest in yourself. You got to figure out what that niche is going to be early on. And like you said, you got to find a mentor, someone who's willing to bring you in. And look, you might have to work for free for a little while. That's just the way this game goes. the first 3-4 years, you don't make any money. You got to learn, pay your dues. And then, there's the good thing is, I'm in my 40s, but there's a lot of, advisors in their 60s now. A large part of our industry is aging. So if you can get in with one of these guys who's willing to invest in you when he retires, you could be that succession plan. So that's something to look at as well.
Right. So you had a mentor yourself? Just curious. Like, did you?
Yeah, I didn't actually. No,
Wow.
I didn't have a mentor, and I think that actually took me a lot longer
Right.
because there wasn't really anybody at that time. I kind of learned it all myself, and that's why like I tell people is college isn't important, but education is everything, right? And so for me, I have degrees from Wharton, Arizona State, National University of Singapore, UCLA Anderson, because I needed that education. And just for me, that was the easiest path, especially in finance. It was a clearly directed path, but it took me a long time and $500,000 to do that. If there was a way to expedite that, if someone was willing to invest in me, because look, like you learn, okay, buy stocks with low PE multiples. Okay, I could probably teach that to someone in a week, but through a traditional finance course, it takes you a year and a half because they just keep beating the same thing into you. So the traditional system for education is broken, I believe. It needs to be overhauled, but that doesn't mean you don't need education. So people out there, I think, are hanging their hats on these few people that are multi-billionaires who didn't go to college. Well, yeah, they didn't go to college, or they point to Zuckerberg, who dropped out of school. Well, he dropped out of Harvard, right? So, and that was after a couple of years. And it's not that he wasn't educated, right? So you have to get educated, whether that's through a mentor. There's so many valuable resources online today. You have to continue to invest in yourself.
100%. I agree 100%. Let me ask you, like, for those that are looking into investing into stocks or like, what are your favorites? I hear you talk a lot about Zoom, about this type of businesses, like to be paying close attention. Like, could you give any insight on what you think, like, people who want to invest in stocks should be paying attention to?
Yeah, well, I think there's two schools of thought in terms of investing. First of all, are you an income investor or are you a growth investor, right? And so when you look at a stock like Amazon, obviously they've been dominating for years. They're $2 trillion company, still growing their top line at 20%, which is unheard of, right? So that's a great growth company that's obviously changing the landscape and just dominating, and I think they will for years to come. But they don't pay a dividend. Right. So it's kind of like one of those things where you, as a real estate investor, if you're buying a house that's like all screwed up, you got to fix it and you're going to flip it. Well, during that time, you're not getting any income. What your hope is at some point in time, you're going to be able to sell it to somebody else, and that capital appreciation is how you're going to benefit. That's kind of your Amazons, where if you buy a multifamily complex, 4-unit, whatever it is, that's got 4 good tenants in it that are paying it, it's not going to have that growth of like that, fixer upper that you had. Maybe it's growing 5-6%, but it's got that steady cash flow that you can predict. And so for those, I like the boring companies like Procter and Gamble, right? Because I know they're going to pay me a 3% dividend every year. Every year for the last 62 years, they've actually increased it. So they've given me a raise every year. People are always going to brush their teeth. They're always going to wipe their ass, all those things, right? Whether it's a recession or a good economy. I like those companies. And I talk about a barbell approach. Own some of those for the dividends that are coming in. But yeah, like, what's the next Amazon? Well, we talk about, I like Zoom a lot. It's not a cheap stock, but Amazon, if you can look back at me for the last 9-10 years, I've argued with so many people from $300. I had no gray hair back then. My voice is a little bit higher. I was arguing with people 10, 11 years ago that they needed to buy Amazon when it was $200 a share. Now it's almost $4,000 a share. So you have to have conviction, but look where things are going. Do you think Zoom is going away anytime soon? I mean, absolutely not. I mean, we've got probably different people in my office have had 6-7 Zoom meetings a day today. I like it a lot better than having to get on a plane, travel somewhere. We're so much more efficient. And when you think about the big corporations, you think all of a sudden they're going to cut off Zoom and start going back to their old travel budget when they're making so much more money now? No. Yeah. So look at players like that, where as this economy changes, think about those leaders of tomorrow. Think about the General Electric, the Coca-Cola, the Procter and Gamble of the next 10, 15 years, not what happened before.
Right, 100%, and it's just so convenient. Like we right now we having this interview. It's so easier than having to like you get to where I'm at, or me to get where you're at, set up everything over there and all that. So it's definitely changing the way the business is done. Let me ask you one more question.
Yeah.
Like I own I have Alliance Realty, right? It's a real estate company. Now we also have Alliance Property Management,
Yeah.
and the next thing that we are gonna open is Alliance Mortgage, right?
Okay.
So basically, very similar to Albert, but I wanted to ask you, like, what are some metrics? I hear you talk about there's some key metrics
Yeah.
in order that like a business owner should track closely for to increase the valuation of the company.
Yeah.
Okay, so like what are those key metrics that I should have like closely looking at to make sure I'm increasing the valuation of the company?
Yeah. Well, I think the first thing comes to seeing, do you have a strategy, right? A lot of people will tell me they have a strategy, they don't have a strategy. And really, what is a strategy? Like I always tell people, and everyone has different, answers for what a strategy is or what they think it is. But really, it's the ability to take your core competencies, your competitive advantages, and solve a client's needs better than your competitor to achieve your own strategic objectives in the current environment. And let's back that up. So first of all, you need to know what your strategic objectives are. So what are you trying to achieve? And that always should be a couple of things. It should be revenue focused. It should be market share focused. So you talked about property management, right? And so what I always like to see, if I came in and worked with you, I'd say, okay, well, where do you do property management? Okay, Dade County or whatever it is. Okay, what percentage of market share do you have in Dade County? Sometimes you won't know, right?
Right.
You first of all, you should know what the total addressable market is. Well, there's 10,000 potential, residential units that we can do property management on. Okay, so what we need to do is have 5,001, because if we're going to be somewhere, we want to be the best and we want to have controlling market share. So we kind of start there to see, okay, what's the market share? And then by those 5,001 units, how much revenue are we going to have? So at the top line of your business on everything, you should start looking at it from a revenue source, from a market share source. You don't want to be number 2, 3, 5, or 10. So now, do you get there overnight? No, but that's where your KPIs come in, because now as a CEO, you're setting these high level objectives, but then you go out to your salespeople, to your managers, and you set key performance indicators to say, okay, we want to get to 5,000 in 2-3 years. This year, we need to get to 1,000. What is that going to take? And so you say, okay, that takes you making 22 calls a day, closing this many business. So they have very specifics now, what they need to do that are tied into the company's overall picture. And then your compensation model, guess what? It should be tied to specifically what they need to do. Because if they're doing their job, they should be incentivized for that. So now you take the company's larger objectives, you break it down into key performance indicators, which are different for every department. Everyone's got a different role to play in getting those 5,001 units. But see how that all works together? CEO sets the strategy. So everyone's tied in, buys into your vision, and everyone knows that they have a role to play in getting in that, and then they're compensated for that. Sounds simple, but no one does it.
Oh man, I love it. I love it. That was such a great answer and value right there. I'm definitely gonna watch this again myself. I love it. I love it. I love it. Hey, Rob, again, man, it's such a blessing and honor to have you here on the Hustling Podcast. And I'm gonna put your information so anybody watching this is gonna have a Rob Luna Instagram. So go follow Rob, man. You have so much wisdom, and I love it. I love it. And thank you so much for being here. And if there's anything you want to say to the crowd before we wrap it up, and thank you, man.
No, I would just say, man, follow this guy. Like he's exactly doing what I tell people do. Find yourself a mentor, because the great thing, like I said, I made some mistakes, but if I would have had a mentor that was willing to tell me those mistakes earlier on, that would have expedited the path for me. So I think you're doing it right. You're out there, you're implementing the things, you're living it, what Albert says to does. He's a good friend of mine. He's been very successful. And so I think, you're doing everything right. And if you guys are sitting there watching this and it doesn't inspire you to go out there and do something, to be an entrepreneur, to get out there and be the best of your field, like there's no room for mediocrity anymore these days. Like I said, the internet got rid of the average. Like, our motto at our firm is go above average. So what is it you're going to do that's an additional? Otherwise, if you're just going to steer there, Google's going to eat you for lunch. Go out there, be better, create value, deliver that to your customers, and you have to think about nothing other than annihilating your competitors because they're after you.
That's it, man. You guys heard it from the Rob Luna himself, brother. Thank you so much again for being here. Okay.
Of course, man. Keep up the
Blessings.
good work, brother. All right.
All
Congrats.
right. All
All right,
right.
thanks.